name is Paul Long, trusted business lender for the South Sound in Tacoma, Washington.
And I'm Greg Martin, the entrepreneur's banker in Bryan, College Station, Texas.
And we are two bankers getting together to help educate small business in America by sharing with you how we see it. In this episode, we're going to talk about sacrificing long-term stability versus paying tax. Now, there's always one thing that is always a battle in banking and finance, and that's that bankers and CPAs, there's usually a battle between the two. Well, why is that? Well, you as the business owner want to pay the least amount of taxes as possible. I get that. I don't want to pay a lot of tax either. However, banks want to see you making tons of money. Well, as you can tell, that's a double-edged sword. So the real solution is, if you know you're going to be making large purchases coming up in the next year, you need to make sure you're talking to your CPA and your banker.
Yep.
But you need to make sure that you got your team behind you if you know you're going to be doing something, so you're making sure that you have the proper amount of income to be able to support the debt. So, for example, let's say, for example, we have a client that wants to expense everything in 2018. So they had a large loss. Well, however, in 2019, they wanted to buy a building. Well, the banker is going to go back and look at historical, because that's what we like to do, not projected.
Right.
It was negative. And so now he has to wait another year. And that's really sad to be able to have to share with the news on that. So, Greg, take on the rest of it.
Well, Paul, when I was thinking about this, I actually thought about a client that I had, and he really got some bad advice from his accountant at the end of the year. And I'm not besmirching the accountant or anything like that, but a lot of times we see in November and December specifically, we have entrepreneurs that come up and say, look, hey, Greg, I've had an amazing year, and you know it, you've seen my financials, you've seen my account, but I just talked with my CPA, and they said that if I don't want to pay $100,000 in taxes, then I've got to go buy some equipment. And normally I understand that that's great, but what I would ask you to consider is how are you actually going to get that equipment? In the instance that I was talking about, this was in 2007, and this client of mine that I had, he was actually in the home building industry. And we all know what happened in 2008. But in 2007 is the best year ever. So I had a client go out and said, look, I don't want to pay the taxes. So he went and he bought a large piece of equipment and he financed it for like 6 years. And then 2008 happened. And the cash flow just dropped off the face of the map. So not only when you're talking about understanding your tax liability and not sacrificing your long-term stability in order to avoid taxes, you've got to think about, one, what am I going to do in the next year? But then two, how is this, if I finance it, I don't pay cash for it, how's it going to impact me? If I do pay cash for it and I need to get my hands on that cash next year, how's that going to impact me? So let's talk through this with you, the entrepreneur, with your trusted business advisor, your banker, and with your CPA, to be able to come alongside and understand where you want to go in the next year, and then to be able to give you the best advice and have an honest and frank discussions of the cost and the benefits of the outcome of that choice.
That's very true. That's a good tip. Well, thanks so much for watching. For more topics from Paul and Greg, visit our websites, myself at paultlong.com or Greg's at theentrepreneursbanker.com. See you on a future episode. See ya.
See ya.